Next, learn risk management well and make that your initial, very first thing that you want to master. So you're controlling your impulses to stop telling everybody your business, okay? It's your business. It's not their business. So stop giving your business to someone else. Next in line, it's the risk. You have to understand what you're getting involved in. If you're going to be trading with live funds, you are losing money. That's a 100% guarantee you are losing money. There is never, ever going to be a trader that starts and never has a loss. My very first trade was a loss. I lost 50% of my account overnight. An orange juice option. I had no idea what I was doing. I was baptized, thrown in the water, and drowned. Okay, it was just that short and sweet. And I closed the account, asked for the remainder of my account, and that was the end of my Fox Investments career. That was the brokerage firm I used at the time. And I had to go and discover how to actually look at charts and learn a little bit more about the risks. So I didn't understand risks when I got into trading. I thought that it should work right away because I saw the book. The book said it does this. So therefore, when I looked at the chart, orange juice should have performed the same way because that's what this guy said in the book. You know, this guy told me in at least 3 pages that the market, when it does this wiggle and waggle, then I should expect it to move this particular way. And where does he get off telling me this and then it not being true? You see where the disconnection is? That was how I looked at it because I didn't want to take the responsibility of the risks. And I figured, well, I'm in an option. What's the worst that could happen? All of my money could have been gone. That's the worst. And in one day, overnight, while I was sleeping, woke up expecting to see I'm gonna be in the profits. Yeah, I wasn't expecting that. Down 50%. Welcome to trading, Michael. And it was a shock. And I just completely collapsed. Said, give me my money. I want out. And that money couldn't get back to me fast enough. And back then, they'd sent it in a check. And you had to wait for the check to come in the mail. It was awful. So the first thing you want to be focusing on is managing risk and understanding the underlying risks that's available to you if you trade. You want to appreciate the percent over the dollar gain or loss. When I first started, I was interested in making a specific dollar amount. I didn't understand compound interest. I didn't understand the Kelly criterion, optimal F, none of the advanced money management theories that I adhere to now. And I just looked for dollars. You know, if I can make $500 on this move, that's what I want to make. And my stop loss was what was the maximum I could take. And that's exactly what I was doing because I was afraid I was going to get stopped out. So I had this unrealistic stop loss that was just unbelievably wide, or I didn't have one. I was using a mental stop, which will drive you mental if you're driving in a truck 13 hours a day, getting out, loading canned soda and junk food into candy machines and going around and fixing machines that aren't right. And you're constantly wondering what the market's doing and you don't have a stop loss. Yeah, it's already bad enough that you have to time the market and pick the right direction. But now you got to add to it that you're doing it blind with no stop loss and anything can happen. And that's what I was doing. I mean, literally, I was like a cowboy out there riding bulls with no experience whatsoever. And if I was thrown off, it was always going to be the worst case. It was really going to be bad. Every single time I took a loss, it was going to be bad. Either I got crushed and I got out because I couldn't handle the pain anymore, or if I had to stop, it was running against me, taking me out, and it was going to be the maximum risk that I could absorb in that trade. So you want to appreciate the percentage of what you are taking on as risk, also with your gains. So don't be impressed with a specific dollar amount, or don't look at a specific dollar amount as, well, it doesn't hurt that bad because it's only $300. But if your account is $3,000, that's 10%. That's considerable. You don't want to do that because you can't do too many of those and not see your account be lower to a level where it's a little bit difficult to come back from that as a new trader. So appreciate the percentage over dollar gain or loss. Learn to limit trade frequency. I felt that since the markets were opening up tomorrow, I had to be in there. So I was over trading, and if I got a profit and I was able to get out in intraday, I would well, that was fun. I want to go in there and do it again. When there was 20 minutes left in the trading session, because I was trading commodities, they had pit hours where it would open at this time and close at this time. And I figured, well, it's still open. Anything can happen. And if I'm right, man, I could make some more money before it closes. Had no idea what I was doing, folks. Zero idea. I was looking at these charts, and they were speaking to me, and it was all the wrong things. It was telling me gamble, and that's what I was doing. I had money in the account. There was hours still left in the trading, or 20 minutes in this case, as an example, hypothetically, and I was going in there. And if I could get more money before the close, that's what I was doing. And that's what hurt me, because I didn't understand the risk. When you're getting close to the end of the session, the end of the trading day, or the end of the week, you have to know that there's a large degree of risk in the fact that you're probably not going to see any really major move at that point, because it's already behind you. And you want to limit the number of trades you take, because the more frequency you have in your trades, the more likely you're going to lose. And if you have a lot of trades, you're going to have a lot more losses, and losses mount up, and you don't want that to occur, especially as a developing trader. You really don't want that to occur at any time, really, but you have to learn to limit your trade frequency. Avoid short-term trading, turning it into long-term trading. Long-term trading. When I first started, I had no idea on what style of trading that I was going to really focus on. I was being told I wanted to be a position trader. You get on the daily chart, catch a 1, 2, 3, hold it for 3, 4, 5, 6 months, and I couldn't do it. Just couldn't do it. And when I started trading with short-term strategies and such, when I was in winners that started to move a lot for me, if you trade of any length of time, eventually you're going to get lucky with something. And when it starts moving in your favor really explosively, something happens inside of our brain. It's like, okay, this was only going to be a trade for a couple hours and maybe make, 5 or 6 handles in the S&P, or 100 pips in the Forex, okay, or a $2.50 move in the stock that you're trading. But now, because it's exploded, you're like, well, this is now a 6-month trade. And you end up holding on to a winner turn loser. And you changed your strategy from it was going to be a short-term trade to now a long-term trade, and that short-term gain turns into a now immediate loss. It's debilitating. Stick to what you were trying to do. When it gets to your objectives, scale out and get your target and move to the sidelines. Don't change strategies while you're in the trade. That never, ever, ever is a good thing. And be content with enough. If you had a profitable week and it's Thursday, close up shop. Who says you have to trade on Friday? What happens if you have a good Monday and Tuesday and it's way beyond your normal return? Why would you want to press your luck? The chances are you're probably going to give some of that back, if not all of it. And when I was younger, I did that a lot in my first 6 years. But I didn't care. It didn't bother me. And I didn't have any appreciation for the risk. Because I figured, well, I'm going to be right eventually. In every trade, I was swinging for the fences. And I wanted to make lots and lots of money. But the problem with that is, because I was taking on so much risk, when I had a little bit of a profit, I would close because I just couldn't handle it anymore. It was wearing me down. Like, I'm expecting to make $1,000 in this trade. All right, I'm up $250. I just got to get out. I'm fatigued. That's what the market will do to you if you have no appreciation for the risk. Don't undermine your trading by not tackling the first lesson in risk management. You have to understand it and how you personally engage with the marketplace and how you are, I guess, adversely affected. I guess that's the train of thought I'm trying to communicate here, because unless you feel the pain of being in a market that's not moving in your favor or screaming against you, you're not going to fully appreciate what I'm saying here. And as a younger man, I saw lots of equity swings that would make anyone else nauseous, and I didn't care. I had no appreciation. I had no respect for the marketplace, because I figured I'm going to get it right eventually. And I went through many accounts, not one or two, many, like 14 individual trading accounts. And I would save up money. My first account was with a credit card. And then the second account was with another credit card, $2,600 on a Nations Bank credit card Visa. And you pay a lot of percentage in terms of interest when you borrow cash. And I just was doing everything wrong. But I was not going to be deterred. Moving on, you want to prevent life imbalances. And this is one of the things that I failed miserably at. I have a pretty large family. I have 5 children. One that was brought in